Mortgage rates could literally drop a half a point if the government just took away this stupid rule. Imagine waking up tomorrow, interest rates drop by a half a point because the government took out this dumb rule, this stupid fee that they're charging banks to buy treasuries. There's a stupid rule that you've never heard of. Actually, the reason why we know it would work is because they actually suspended it. They stopped this rule during the pandemic when they put all that money out there and gave it to the people, and it flooded the banks with all the money. Remember, people had that crazy savings and the banks had to go put the money back into treasuries. Well, there's a little fee. It's not a sexy topic. It's not being advertised out there, but Scott Bessent, our Treasury Secretary, he actually discovered this while new at his job. He was like, what is this? And let me tell you exactly what it is, what it means, what it's called, and what this really could mean if they can get rid of this rule, because it's really stupid and it doesn't make any sense. And people have been bitching about it for a while. It's just taking forever to get there. But before I jump in and give you all this lovely information, and trust me, it's not the most favorite topic, it's pretty boring, but if rates drop by a half a point, you're gonna listen. If we haven't met, my name is Kenny Simpson. I focus on 1 to 4 unit financing. That means I help people buy and refinance 1 to 4 unit properties. I've been doing it 20 years. Yeah, I'm aging myself. Helped over 5,000 clients, billions of dollars of loans. And I shoot videos like this to break down topics like this or find topics like this. They're gonna help educate you on what is going on out there in this crazy world. It doesn't matter if you're a first-time home buyer, a complicated self-employed borrower, or you're a real estate investor, whatever it may be, I'm here to help. So I talk about tons of articles, topics on this channel. But if you're not following me, you should follow me on social. You should get on my email game. You're probably watching this. You are on my email game. If you're not, you got to watch it. But let's dive into the topic, because I'm telling you, there's many levers that the feds can pull that could change interest rates, and they might change quickly. This is called a supplementary leverage ratio. In short, at the government, they use the term SLR. It's deep in the banking regulation. It's not easy. It's not low-hanging fruit. That's why Scott Bessent found it. But if they can change the rule, basically think of the rule as a fee and get rid of it, banks would do more of buying treasuries and those rates would come down. So let's dive a little bit more how it would work, how we'd unwind this, and how do we get these rates down right away. Okay, so here's a nerd moment real quick. I got to get into explain what this is, how it works, because we got to get past that stuff, right? So you understand what I'm talking about. The SLR basically says banks have to hold a certain amount of capital against their assets, including US treasuries. Even though treasuries are the safest investment on earth, banks still have to tie up their money when they buy them. Why? Great question. No one really knows. So let me repeat what I just said, if you didn't catch it, because you might want to catch this one. It's a little important. The SLR basically says banks have to hold a certain amount of capital against their assets. They're forced to, including US treasuries. Yes, the government basically forces banks to buy US treasuries. If you guys didn't know that, as I told you, I'm going to be going through a lot of the plumbing of how things work out there, which none of you guys probably ever heard of any of this crap, boring stuff, because it's not fun. It's not sexy, but we got to learn about it. Basically, it's like wearing a helmet while you're sleeping. It's completely unnecessary. It's over the top, and it's causing banks to not buy as many treasuries as they would if there wasn't this stupid SLR rule. So why does it matter? Why get rid of it? Why is it here? Basically, all it does, to dumb it down, is if the banks are required to hold treasuries and buy treasuries, it just is a fee. So it makes it more expensive for them to go out and buy treasuries. So the US government says, buy our treasuries, and then we're going to charge you a fee. What? Does that make any sense? No, it doesn't. So think about this. If the banks aren't buying treasuries, mortgage rates go up. The more people that buy treasuries, remember, more supply, less demand, rates go down. Kind of what happened during the pandemic. A lot of people bought our treasuries. Even the Federal Reserve printed money and bought them. Banks bought them. People overseas bought them. Other countries bought them, right? Remember, everybody just flies to treasuries. The stock market's going crazy, or their currency's going crazy. People love US treasuries all over the world. That's why we are the dollar denominator. That's why we can print money. That's why rates go up and down. Like, we are the currency of the world at this point in time today. So let me give you a flashback of exactly how this happened during COVID, because why I'm telling you the story, it's really important, because remember, COVID, it worked. They took it away. The banks were forced to buy more treasuries because they had too much liquidity. And when they bought it, they took away this rule to avoid the fee, and rates went down more than they would have if they didn't do this. Shocker. So if we remove the rule and banks buy more treasuries, we have lower rates. Like that. Scott Besson says anywhere from 30 to 70 basis points. He thinks this could be, if this rule goes through overnight, rates could go down because the banks would be like, let's buy more treasuries. I'm not getting hit whack with the fee. This is crazy. So COVID hits, the Feds pump trillions of dollars into the system. Banks are swimming in cash, but can't invest in treasuries because of SLR rule. It's like giving a chef all of the ingredients and saying, but don't cook anything. So the Fed stepped in and temporarily suspended the SLR rule. In April 2020, suddenly the banks could buy treasuries without capital penalties. What happened? Bond yields dropped, mortgage rates hit a record low, and the refi boom exploded. Experts estimate that single move may have dropped interest rates up to 0.5 point, which is massive in the mortgage world. So fast forward till today, what happened? Scott Besson went into office as Treasury Secretary. I told you, went in there, lifted under the car hood, found this out and said, wait a second, this is crazy. We got to get rid of this. Remember, this is part of some of their deregulation. We got to get rid of this stupid fee, throw it out. We don't need this. Let's incentivize the banks to buy more treasuries. It's better for the US government. It's better for the banks. And also, it's better for everybody in the real estate business and everybody that loves low rates, which is everybody out there, because low rates matter when it comes to anything, whether it's your credit card, buying a car, financing anything, buying a house, you name it, starting a business, interest rates matter, and stuff like this really does matter. So in the SLR rule, we're not going to go into it. There's obviously there's a formula of how it works, how they calculate things. So what would exactly change with this rule? How could it make a difference? So they're talking about, number one, exclude treasuries and cash from the calculation, just like we did in 2020, or two, lower the capital requirements from 5% to something close to 3%, freeing up bank balance sheet. That means banks' money overall. Either of those would likely drive more demand to treasuries, bringing down yields and pushing rates lower. So, hey, guys, when somebody says, hey, how are we going to get rates lower? And I talk about this every day and they say, Powell has to cut rates. That's not it. There's many things. Let's go through it. SLR, they could reform this. Rates could come down tomorrow. They could do loan level price adjustments on rates. They could help tomorrow. The spread between the 10-year and 30-year fix, if that becomes lower, that could lower interest rates tomorrow. If the 10-year treasury comes down, that could lower interest rates tomorrow. Folks, it's not one way to get rates down. There's many levers they can pull to get these interest rates down. You just have to know where to look, where to find it. Keep staying tuned to this channel because information like this, I'm going to keep putting out, weekly, all these nuggets that matter that are going to move the needle. So there's a lot of things that are being looked at right now when it comes to getting interest rates down, making things more efficient. They're doging it. So this is just another basically wrench in the gear that shouldn't be here, that's causing interest rates remaining higher. If we just basically pull the lever down, let this go through, make it make sense, deregulate it, get through, and we'd be off to the races with some lower rates. We don't know when this would happen. Scott Besson, last interview I heard, said this could take, it could take months, maybe third, fourth quarter this year. It'd be great. So anyways, keep the faith, keep those fingers and toes crossed that this would pass. It'd be just a great, amazing win for the real estate business because we can use lower rates. So if that interest rate you're getting quoted 7 now, it could go down to 6.5 or lower. Hey, share this video with somebody else that might like it because I know you probably, if you're still watching, learn something from it. But also too, if you have anything I can help you out with, reach out, feel free, refi, purchase, I'm here. Make sure you're following me on social media. Anyways, thanks for watching, guys. We'll talk to you soon. And hey, I hope you learned a lot in this video and keep watching all my other ones.